There you have it, Prashant, the first bet.
Well, I think it's looking pretty... it's a slower kind of a start as expected.
We have a screen that's looking a little bit like the post-Diwali party sort of sluggishness.
For the markets, not so much in a festive mode today. We've seen Nifty declining by 75 points.
So yes, maybe not that festive, maybe taking it a little easy after the Diwali party, but guess where the party is continuing and kicking off? It's the mid-caps. We are getting a close, which is actually fairly quiet, not much change on the large cap screen, at least the Nifty was largely down about 80-90 points. Hello and welcome to Markets Today. I'm Arundhati Ramnan, and here are the top market headlines that we're tracking for you. Markets take a breather after a strong start to somewhat 2080. Sensex and Nifty drop into the red as traders await Indian inflation numbers later in the day and US inflation data later in the week. The rupee ends flat after sticking to a tight range. Eicher Motors delivers a strong set of second quarter numbers. Margin expands by 310 basis points on a year-over-year basis, while market share also rises. Brokerages Morgan Stanley and Jefferies are also bullish on the stock. Coal India shares surged to the highest level in 8 years as it delivers a beat in the second quarter, owing to better than expected realizations. Brokerage Jefferies upgrades the stock to a buy rating with a target price of 385 rupees apiece. CLSA and Citi also remain bullish. Biocon slips on missing sales and profit estimates as business momentum slows, coupled with pricing pressure and delays in new approvals. Glenmark Pharma too slips on a weak showing on margins and poor sales in US and India. A majority of market participants are expecting a steady somewhat 2080. A CNBC-TV18 poll shows 45% expect returns of around 9% over the next 12 months. Half the people surveyed believe this could be the year of the large caps. Financials is the most preferred sector. Here's the lineup of what we have in store for you on the show today. In Market Opinion, we have Saurabh Mukherjee, founder at Marcellus Investment Managers. In Big Corporate Voices, we have Satish Pai, the managing director of Hindalco. To the first headline and the day's market action, Dalal Street took a breather after a strong start to somewhat 2080. A range-bound session saw the Nifty and Sensex end the day 0.5% lower. Broader markets fared better than the blue chips, but mid-caps ended the day mildly in the green. Surbhi Upadhyay joins us with a wrap of all the action on Dalal Street. Surbhi, quite a sluggish day today? Well, it was a quieter day of trade after the Diwali break and the Muhurat trading session. Volumes were on the thinner side and largely consolidation played out on the Nifty at least, where that index was in less than 100-point range, with the pivot being pretty much around the 19,400 handle. The weak area of the market today was IT and financials, both banks and non-banks, and that kind of kept a lid on any kind of excitement or midday recovery. So if I talk about the losers, then from the financial universe, you have names like SBI Life, even Bajaj Finance. If I move beyond, then stocks like Reliance, ITC, the big boys, they were a little sluggish. And the IT champions, TCS and Infosys, they also didn't really add to the tally. In fact, they were dragging on the lower side. So this was a red pocket of the market. However, what worked well were some of the result reactions playing out. Coal India has had a fantastic run after the numbers, solid show on numbers coming through, and also the dividend, and the market really loved every bit of that. Hindalco and Eicher Motors were also some positive result reactions and good commentary coming in from brokerages as well. Mid-caps did see that recovery that large caps did not, and that tells you about the market and just the construct overall. The mid-cap index managed a hint of green by the time we closed out, and PSUs were once again an extremely strong theme in the market, and that resonates in all of the stocks. I mean, specifically PSU banks, UCO Bank, IOB, and even some of the non-bank names like BHEL, big move on a lot of these stocks. There were some interesting result reactions playing out. Glenmark on the way down, a lot of restatement in those numbers. There was Biocon, again, that number did not go down too well with the street. But on the other side, there's Sun Pharma. Great numbers, margin expansion, and the stock was up about 3.5%. So largely driven more by earnings and that big issue about financials and IT being weak. That kind of sums up trade today. Of course, tomorrow we'll come in and we'll start tracking US inflation data because the CPI numbers come in there tomorrow. And that sets the tone for, of course, what happens to bond yields as well as the dollar. After the holiday, the midweek holiday that we get, we'll come and pick up the pieces, of course, on Wednesday. All right, Surabhi, thank you so much for wrapping up all of that market action for us. But also, let's get you some opinion now. Saurabh Mukherjee, founder at Marcellus Investment Managers, believes that chemicals, financial services space could make a comeback by 2024 to 2025, driven by robust export franchises. He also highlights his top listed companies in his portfolio. Take a look.
If you look at the setup in the market, the export-centric small caps, companies whose products tend to get sold in the Western world, or companies that are competing with Chinese export, those companies have been beaten up quite badly in the small cap space. As the global economy recovers over the next couple of years, companies in IT services, companies in specialty chemicals, pharmaceuticals, which have strong export franchises, I think will see the comeback through 2024-25. So now Little Champs portfolio, we've sold Amrutanjan. We sold Amrutanjan through the last 6 or 7 weeks. And what we've added is 3 stocks. We've added RHI Magnesita. I think I spoke about RHI Magnesita a couple of months ago. In Little Champs, we've also added Serra Sanitaryware. This is a company we used to own 4 or 5 years ago. Then we sold it. I guess we shouldn't have sold it 5 years ago. When we sold it, we shouldn't have sold it. We've also added Trent. We built that position over the last 10 weeks or so. Results have been tremendous, but what's really led us to buying Trent over the last couple of months is the fact that not only has Zudio turned around, we reckon Star Bazaar is also becoming profitable.
To the second headline now, Eicher Motors gained close to 2% on the back of a robust second quarter earnings, beating street estimates across parameters. Net profit soared 54%, while revenue also grew 17% on an annual basis. EBITDA and margins also improved on a yearly basis. Sonal Bhutra is here with a snapshot and what brokerages have to say about the earnings. Sonal?
Well, that's what the brokerages are saying, that they are not so worried about competition. Competitive intensity did keep the stock valuations in check, but that is not something that the investors should worry about. First, let's talk about the numbers. Good numbers. Revenues up 17%, EBITDA up 32%. Margins, they have increased by 320 basis points on a YY basis, leading to a profit growth of 55%. Their domestic motorcycle market share has risen to 8.2% in first half of FY24 versus 7.8% in FY23. This is the share of 250cc and above. That's not it. They are gaining market share in the 125cc and above market as well, according to the company. And their Royal Enfield share of more than 125cc bikes has risen to 32% in first half of FY24. So market share gains continue to be the theme for Eicher Motors in the first half of FY24. Morgan Stanley is bullish. They have a target price of 3,552, but they have an equal weight rating on the stock. They say EBITDA ahead of estimates driven largely by a gross margin beat. Jefferies says that second quarter EBITDA and PAT rose more than 50 to 55%. This is 6 to 9% higher than what they had estimated as well. And Jefferies also says that competitive concerns did weigh on valuations, but they see limited impact from Harley and Triumph launches, and there could be a potential re-rating of the stock as well as long-term sustainability of market share remains. So that's the reason why the stock is perking up in trade.
All right, Sonal, thank you so much for those details. Now, the third headline today, Coal India surged 5%. Brokerage firms have put out a mixed outlook on the stock after a strong second quarter performance by the company. Jefferies has upgraded the stock to a buy rating, while CLSA has downgraded the stock. Nigel D'Souza joins us now with the details. And Nigel, talk to us about why the stock is buzzing in trade.
Well, Coal India's numbers were a beat. No two ways about it. If you look at the top line, the EBITDA as well as the profitability, all of them looked quite good. And we already had the volume numbers with us. So the beat came in on account of higher realizations, in particular the FSA realizations, because the e-auction realizations were as weak as expected. They also threw in a dividend of close to around 15 rupees, which the street likes very, very much. Talking about brokerages, I'm looking at 2 brokerages. One is Jefferies. They upgraded the stock to buy with a target price of 385 rupees per share. They have gone ahead and they have upped the EPS estimates by around 18 to around 42%. They also say that the stock is trading around 6.5 times PE, which is reasonable. In the past, it's traded at even double digits. Now, they have upped their volume trajectory, and they believe the volume trajectory has been strong and is likely to sustain. Hence, they have upped it, and now they are factoring in close to around 7% volume CAGR for the coming years. The negatives, they say it's already more or less already been witnessed, whether you're talking about the big decline in e-auction prices or also the wage hike that we have already seen. Moving to CLSA, they have downgraded the stock from buy to outperform following the recent rally, though they have upped their target price and they have also adjusted their estimates, earnings estimates upwards. They say that yes, the volume growth is likely to remain high, but they also say the best of pricing in the near term is likely to be behind. So that's the reason why, they have turned their rating on the stock. Back to you.
So mixed outlook there for Coal India. But moving on, Hindalco perked up on the back of a good second quarter earnings. Both revenue and EBITDA came in strong. Margin expanded as well. But aluminium business came under pressure. Satish Pai, the managing director of Hindalco, says that the global macros seem to be on a positive trend. He guided for copper quarterly EBITDA range to be between 550 to 600 crore rupees. Listen in to what he had to say.
I have been fairly consistently saying that LME is going to be near about this 2200s till the macroeconomic environment gets clearer, people get more comfortable with the US economy, interest rates, Chinese demand, etc. So happy to say that most of it seems to be more on a positive trend. Coming to our aluminium performance in Q2, we did very well, $750 per ton EBITDA. This is largely because coal prices went down about 15% from the previous quarter. I would guide that, we had a very good quarter with sales and prices and mix being perfect. I think we'll be in that 550 to 600 range going forward.
On that note, it is time for us to take a short break. But coming up, we'll bring you all of the other market action on the other side. Stay tuned. Welcome back. You're still with us on Markets Today. To the fourth headline then. Biocon slipped over 3% on missing sales and profit estimates. Business momentum slowed, coupled with pricing pressure and delays in new approvals. Ekta Batra joins in with the key highlights. Ekta, tell us about the results and what brokerage is made of it.
Well, yes, the Biocon numbers were a bit disappointing if you compare them to what the street was anticipating. So the revenue was up around 49%. The street was anticipating around a 57% growth on a year-on-year basis. Now, the reason for that was because the company integrated Viatris's biosimilar business into their numbers this quarter, which resulted in this jump that you're seeing. Now, margins came in at 21.4%. The street was anticipating 22 to 23%. And the profit, however, was higher than estimates. Now, the biosimilar business, which is now 55% of their sales, was up around 97% on a year-on-year basis. That is because of the integration of Viatris. But the generic segment, which is around 19% of sales, was sluggish. It was up only around 4% on a year-on-year basis. Now, Goldman Sachs has reported on Biocon, and they have a buy with a target price of 280. According to them, the reported sales and EBITDA was below expectations. The revenue momentum was a mixed bag. The margins were a tad weaker. They've lowered their FY24-26 EPS by 5 to 7%. Motilal neutral, target price 220. Delay in new approvals has dragged the biosimilar prospects. Pricing pressure in the API segment adds to woes.
Right, but Ekta, stay on with us. Glenmark Pharma also slipped 5% in today's trade. The pharma major reported an exceptional loss of 68 crore rupees. So Glenmark's margin has dropped to 14% from close to 16% on a yearly basis. Ekta, you're tracking the stock as well. Tell us more about it.
Well, yes, for Glenmark, it was a sluggish set of numbers, but there are a couple of key points which needs to be taken cognizance of. First is that the numbers were adjusted for Glenmark Life Sciences stake sale. Separately, there was an exceptional loss of around 67.9 crores this quarter. The exceptional loss included $30 million towards a settlement of price-fixing allegations in the US with the Department of Justice for one particular drug for Glenmark. Now, Q2 FY24 revenue was up around 6% odd. The margins, however, were weaker on a year-on-year basis, so 14% versus 15.9%, and the company recorded a loss this quarter of around 81.9 crores. Yes, there were exceptionals, but maybe it is the margins which really weighed in terms of sentiment. We had India, which was up around 2.8% year-on-year, and North America, which was sluggish, down around 2.2% on a year-on-year basis. Europe, however, did well. So that particular geography was up over 55% on a year-on-year basis. But nonetheless, it seems as though the markets were weighed down by the margins as well as maybe the sluggish performance of India as well as the North American business. The commentary will be awaited, which is on Wednesday in the morning hours in terms of a conference call.
Right, Ekta. Many thanks for those details. Now, in more earnings action, ONGC also posted its second quarter numbers, missing street expectations on almost all parameters. Net profit came in much lower than expected on account of lower crude oil sales. Sonal Butra joins us now with the details. Sonal, take us through the highlights of those earnings.
Well, ONGC reported Q2 numbers, which were slightly lower than CNBC-TV18 poll. Revenues came in at 35,163 crore rupees versus a poll of around 36,800 crore rupees. EBITDA at 18,359 crore rupees, and margins, they were lower by 80 basis points versus the poll of 53% to come in at 52.2%. Profits accordingly were also missed this time to come in at 10,216 crore rupees. Now, if we look at why the numbers were lower than the estimates and on a quarter-on-quarter basis as well, it is because of lower realizations and lower output in both gas and oil segments. In fact, their crude oil realizations came in at $73.50 a barrel, which was impacted by $11 a barrel because of the windfall taxes as well. So yes, it was weaker than what the street was working with. Citi has a buy rating on the stock. They have raised the target price to 230 rupees a share. They say miss was primarily on account of slightly lower crude and gas production and lower gas realizations as well. CLSA agrees, however, they say declining production may be compensated with upcoming projects, and that's why they continue to be bullish on the stock, and they say it is reasonable at current levels.
So weak showing there for ONGC. But Sonal, stay with us. Tata Chemicals also tumbled nearly 2% on the back of a weak second quarter. Net profit dipped over 27% on a yearly basis, while revenue and EBITDA also took a beating on a yearly basis. Sonal, tell us more about Tata Chemicals.
Tata Chemicals reported a weak set. It was a YY decline led by lower realizations. Revenues down 6%, EBITDA was down 11%, margins declined to 20.5%, leading to a profit decline of 27%. The company said volumes were not a problem, demand is stable, but realizations for soda ash, they have been coming down, and that is something that we've been seeing in the quarter gone by as well. They say that India saw more soda ash imports in the quarter versus previous quarters, coming in at around 27 to 28% versus 14% levels that we saw earlier. And interestingly, most of these imports are coming in from Turkey because Turkey as an economy is seeing lower demand coming in from their southern Europe market, which has seen a decline in demand. So Turkey is looking for newer markets like India, where demand is very high for soda ash. So these imports are coming in at lower prices, leading to a dip in their realizations as well. On the back of these numbers, Nirmal Bang, they have cut their estimates for FY24 and FY25. Because of reduced EBITDA across most of the segments. They've also downgraded the stock to a sell because of realization pressure that the company says is happening right now across geographies.
So Tata Chemicals failing to deliver in the second quarter. Thank you so much for those details, Sonal. Now to the final headline of the day. It was a positive end to Samvat 2079 for the Indian equities, but what does Samvat 2080 have in store? We at CNBC-TV18 polled a number of market experts to find out what they think the road ahead would be for the markets, the key risks and the sectors that are likely to outperform. Nimesh Shah is here with the Samvat Centimeter.
Samvat 2079 ended on a very strong note with gains across the board. In fact, all sectoral indices ended in the green, with the PSU index giving the best returns and emerging as a new leader of this bull run. So we asked the experts what to expect in Samvat 2080. CNBC-TV18 did a dipstick survey across more than 20 market participants to gauge the mood. The biggest feedback was they continue to bet on stocks as a preferred asset class. So that was the highest, 68% voting for stocks. Only small portion of people opting for gold, and fixed income was the second best as the most preferred asset class. So what kind of return should one expect in Samvat 2080? 45% of the market participants see the Nifty ranging between 21 to 22,000. Only a small 9% expects the Nifty to fall below 19,000, but there was an equal amount of bull versus bear, with nearly 13.5% each voting for a Nifty above 22,000 as well as below 19,000 as well. So earning has been a big driving force for this market to outperform. So we asked experts what to expect in terms of earnings in FY25. Nearly 50% of the participants expect the earnings between 12.5 to 15%. There is a small portion who also expects the Nifty earnings to be much higher, between 15 to 17.5%. So that's the earnings perspective. Now, what to expect in terms of sectors which can do well, or what they'll bet on. The biggest feedback is that this could be the year for the return of the large caps. 50% opted for large caps, and only 13.5% said that small caps can continue to outperform. So what are the sectors which can do well in Samvat 2080? Financials stand out in terms of the biggest bet, and within financials, it's the PSU stocks which they expect will continue to outperform. The least preferred sectors were autos, cement, pharma, and manufacturing. All have done well, but now they expect a bit of underperformance there. So what's the key risk for the market going into the next somewhat? The key domestic risk seems to be the general elections in 2024. For almost 55% opted, that's a big risk for the market. From a geopolitical perspective, the biggest risk seems to be two things. One, the geopolitical risk as well as the Fed policy. These were the two big risks from a global perspective. But given the momentum in the market, looks like somewhat 2080 is going to be a good note, but this could be the year of return of the large caps.
I feel India is in a sweet spot, as most of the analysts have said, compared to other emerging markets, despite interest rates going higher, because the Indian economy is growing at a much faster clip than the other economies, and we are always used to a slightly higher interest rate regime than the rest of the countries. So now the interest differential between, say, India and America mortgage rates are about 1–1.5%. So the first time actually Indian equities are looking attractive from emerging points of view also. So I think for the last 6 months you've seen domestic buyers and foreigners selling. I think we might see a reverse of that in this Samvat. We might see foreigners also coming into India, chasing the overperformance that we have. So all in all, I would remain invested in high quality businesses. My mantra has always been the same. Buy a good quality business and stick to it. Ride out the volatility that is almost inevitable, a part of all investment.
The fact is that the euphoria is in some pockets, right? But overall, per se, our market actually has been consolidating for the last 2 years. And that is why the setup is very good. Because, very often if you have a 30–40 year kind of move here, the year after that is very difficult to build on it. But the fact is, I think if you look at markets, not just 1 year, because of course it's Diwali somewhat to somewhat, but if you pull it back 3–4 years, what we've done is just a 5–6% nifty for back-to-back 2 years. So there's no real bubble or euphoria really that there is. And I think that is a very good positive and a base. So when you talk about a sight, a clarity, when the clarity or breakouts happen from long bases of consolidations, that's when the momentum comes in. So I feel that the bull market in India is about to start.
And with that, it is a wrap on this edition of Markets Today. Here's wishing all of you a very happy and prosperous Diwali. But stay tuned to CNBC-TV18. More news and updates continue on the other side.